I think most people, when they think about fast food, they have this really simple picture in their head. It's like a grill, some fries, a drive-through window. It feels so transactional.
It's designed to feel that way. That's kind of the whole point.
Exactly. But when you pull back the curtain, it's this massive global game of logistics and branding and economics. And today we've got the perfect case study.
Oh, it's a fascinating one. It really touches on everything.
We're diving into Restaurant Brands International, RBI. So even if you don't know that name, you definitely know their brands.
Burger King, Tim Hortons, Popeyes, and Firehouse Subs.
Four absolute giants.
Yeah.
And in 2025, they faced a scenario that, it sounds like a nightmare business school problem.
It really was the ultimate stress test. Yeah.
Okay, just imagine this. You're trying to sell burgers to people who are already feeling squeezed, right? But the price of beef, the one thing you absolutely need, spikes by 20%.
A total nightmare. That just destroys your margins.
But then at the same time, you team up with a cartoon sponge.
He lives in a pineapple under the sea.
And suddenly you're having your best quarter for kids' meals in a decade.
Yeah.
It's wild.
That's the story of 2025 right there. Painful economics versus brilliant branding.
So that's what we're digging into. We're unpacking the Q4 and full year 2025 earnings for RBI, which just dropped today, February 12th, 2026.
And we're not just reading numbers.
No. We want to know how a SpongeBob burger saved Burger King's quarter, why Canadians are drinking iced coffee in December, and we need to talk about Popeyes.
We definitely need to talk about Popeyes. There's a big lesson in there about operations.
For sure. Okay, so let's start at the top. The headline numbers came out this morning, and the market seems pretty happy.
They should be. RBI beat expectations. Revenue was $2.47 billion, which beat by over $56 million. Adjusted EPS came in at 96 cents, a beat of 3 cents.
Yeah,
but
there's always a but.
Yeah, those aren't the numbers you should really be looking at if you want to understand the business.
Okay, so if I'm not looking at revenue, where do I look? What's the real story?
The magic number in this whole report is 8.3%.
8.3% of what?
That's their organic adjusted operating income growth.
Okay, organic adjusted operating income. That sounds very technical. Break that down for us.
Right. So operating income is just the profit from the core business before interest and taxes. Organic just means we're not counting growth that came from, buying some other company.
So it's a real growth.
It's real growth from selling more coffee and burgers. And the reason 8.3% is so important is because of the consistency. This is the third year in a row they've hit around 8% growth on that number. In this kind of volatile market with commodity costs all over the place, hitting your target 3 years straight is, it's huge.
So it's about being reliably boring.
Boring is beautiful in a business this big. And they're backing it up with cash. They raised the dividend target to $2.60 a share.
That's a 5% increase.
Exactly. You don't do that if you're worried about the future.
That's a good point. Now, before we get into the brands, I noticed something about where this growth is coming from. We always focus on the U.S.
We do.
But the international segment seems to be the real star here.
Oh, it's carrying the team right now. System-wide sales growth internationally was almost 11% for the year. And here's the stat that blew my mind. Popeyes International.
Yeah.
It just hit a $2 billion run rate.
Wait, $2 billion? Just the international part of Popeyes?
Yes. They doubled that business in 2 years.
Wow. I still think of Popeyes as such an American South kind of brand.
Well, it proves good fried chicken travels, but strategically, this is their hedge, right? When the U.S. market is slow, another market picks up the slack.
Like in France, they have what was it called? The Duomi Starebox?
Yeah, it's a huge hit. A surprise duo meal for €5. The point is, a slowdown in one country doesn't sink the ship.
Which is good, because the U.S. was a bit of a grind. Let's talk about Burger King U.S. This is where the story gets really fun.
The SpongeBob effect.
I have to geek out on this. So in Q4, they launched this SpongeBob menu. They had the Krabby Whopper.
With a square yellow bun. We have to mention the pun.
A square yellow bun. It sounds like such a gimmick, right? But the CEO was raving about it on the call. He said kids' meal incidence was the highest it's been in 10 years.
10 years. And that matters because McDonald's has owned the kids' meal space forever.
It's their fortress.
You don't just steal share from the Happy Meal, but what's really interesting here isn't just the sales spike, it's the retention.
That was the part that got me. It wasn't just a one-off.
No. Parents came for the SpongeBob toy, and they must have realized, hey, the food's actually pretty good now, the service is better, and they came back in January for regular food.
It's like it reintroduced the brand to a whole generation of millennial parents.
Exactly. But, and there is always a but, While sales were okay, the franchisees are getting squeezed.
Right, the beef problem, the cows.
The cows. Beef costs were up over 20% in 2025. That is a massive, massive number for a burger place.
20% is not a small fluctuation. That's a shock to the system.
It is, and you see it in the profitability numbers. The average BK franchisee in the U.S. went from making about $205,000 per store in 2024 down to about $185,000 in 2025.
Ouch. That is a $20,000 pay cut for the owner.
Yeah, and the CFO is clear. If beef prices had just been flat, their profits would have been fine. So the model isn't broken, it's just the input costs are brutal right now.
Is this permanent? Are we just, like, running out of beef?
No, it's cyclical. It's called the cattle cycle. U.S. herds are at historic lows, so ranchers are rebuilding.
How does that work?
To rebuild, you have to hold back female cattle heifers for breeding. You don't send them to market.
Which means even less supply in the short term.
Exactly. It's called heifer retention, and it spikes prices until the new calves are born and grow up, which takes about 2 years.
So you just have to wait it out.
You wait it out, and you focus on what you can control, like operations, the remodels.
Right, the modern image or sizzle remodels. They're at 58% of the system now.
They are, and they're working. The sales lift is real. But they did admit they're slowing the pace down a little bit.
Which makes sense. You can't ask a franchisee who's getting killed on beef prices to spend a few $100,000 on a remodel.
It's a tough ask. But RBI is playing the long game here, especially with the Carroll's acquisition.
That was their biggest franchisee, right?
Over 1,000 stores. RBI bought them, and now they're flipping them or refranchising them to smaller local owner-operators.
Why buy them just to sell them again?
Because a guy who owns 5 restaurants in his own town is always going to run them better than a giant corporation 1,000 miles away.
The owner is actually there. The bathrooms are cleaner.
Exactly. Better service, hotter fries. They're betting that local ownership is the key.
Okay, let's head north of the border. Tim Hortons.
The Canadian icon.
I found a stat in here that just, it doesn't make sense to me. Tim Hortons in Canada, a cold country, grew their cold beverage sales by 8.6% in the fourth quarter.
October, November, December.
Who is drinking iced coffee in Canada in December?
Apparently, a lot of people. It was almost 27% of their total beverage sales. The highest Q4 mix ever.
That's just wild. I mean, Tim's is the double hot coffee place.
It still is.
Right.
But they are successfully pivoting to a younger customer who drinks cold caffeine all year round. It's not just coffee, it's energy, it's refreshment.
And it opens up a whole new part of the day for them.
Precisely. Hot coffee is the morning. A cold brew, or one of their quenchers, you can sell that at 2 in the afternoon. That's the holy grail for a coffee shop.
And they're backing it up with incredible speed. I saw the drive-through times.
Every 20 seconds, a car moves through in the morning.
20 seconds? That's insane.
It creates a habit. If you're late for work, you're not going to the place that takes 4 minutes. You're going to the place that takes 20 seconds. Speed wins the morning.
And speaking of habit, they announced this big partnership with Canadian Tire.
Mm-hmm.
For our listeners who aren't Canadian, explain why that's a big deal.
So, Canadian Tire is an institution, and it has one of the biggest loyalty programs in the country, Triangle Rewards. Tim's has the other one, Tim's Rewards.
And they're connecting them.
They're connecting them. It's like creating a Canadian consumer super app. You earn points on your snow tires to buy your coffee. It just locks you into that ecosystem.
Wow. It's like the Avengers of Canadian retail.
Pretty much. Good luck competing with that combined database.
All right. We can't put it off any longer. We have to talk about the chicken in the room. Popeyes.
The problem child of 2025.
The numbers in the U.S. were not great. Comps down 3.2% for the year. Franchise profitability dropped. There was a big bankruptcy.
Yeah, the U.S. business stumbled badly.
So what's the deal? Is the chicken sandwich war over? Do people just get tired of it?
No, it's not about the chicken. People still love the product. It's an execution problem. The CEO, Josh Kobza, said something really telling on the call. He said, chicken is a service business.
Chicken is a service business. What does he mean by that?
He means it's hard to make. A burger is quick. Bone-in chicken takes time. It has to be battered, fried, it has to rest. If you don't manage your kitchen perfectly, you run out of product at 6 p.m.
And the customer has to wait.
They wait 15 minutes, or they get the wrong order, or the chicken's been sitting too long. Popeyes admitted they got distracted by shiny objects, new wings, new flavors, and they forgot about the basics.
Speed and accuracy.
Exactly. So they brought in a new president, an ops guy, and they're expanding their field operations team by 75%.
75%. What do those people do?
They're coaches. They literally go into the restaurants and stand with the manager and say, okay, let's fix this. Let's figure out how to shave 30 seconds off this process.
Yeah, it's the unsexy, grinding work of fixing a restaurant.
It's totally unsexy, but it's the only way. The leadership team said the fix is straightforward. I don't know if I'd say easy.
Simple, but not easy.
Exactly. The problem is clear. People want the food, they just don't want the wait. That's a solvable problem.
Okay, last big piece here. Let's go to the other side of the world, China.
A total roller coaster.
So a year ago, the story wasn't good.
No, the business was struggling. Sales were down, so RBI did something really bold. They took control of the business themselves, put it on their own books to fix it.
Which is risky for a company that wants to be asset light.
Very risky. But it worked. They stabilized it, got sales positive for 3 straight quarters, proved the model still works in China.
And then after fixing it, they sold it.
They sold a majority stake to a local partner, CPE. And this is the big lesson. You can't run a Chinese empire from Miami. You need local partners, local capital.
Boots on the ground.
And deep pockets. CPE put $350 million into the business. The new goal is to hit 2,500 restaurants there by 2030.
Wow. So that's roughly doubling the size.
Yeah, something RBI could never do on its own from the U.S. It's a smart partnership.
So when you pull it all together, 2025 was a massive stress test.
That's the perfect way to describe it.
You had crazy inflation, a nervous consumer, bad weather.
Yeah.
And they still hit that 8% operating income growth.
They passed the test. And they did it by focusing on fundamentals, remodeling stores, fun marketing, and getting the basics right.
And the guidance for 2026 is more the same.
Steady as she goes. Another year of 8% OI growth and getting back to 5% net restaurant growth. They're saying the storm isn't over, but the ship is sound.
It's so interesting. We spend all this time talking about AI and tech and automation.
All the time. The AI drive-through bot is the shiny object everyone loves.
But when you look at this report, especially the Popeyes story,
yeah,
it just hits you. A multi-billion-dollar business stumbled because it couldn't hand a person the right bag of chicken in under 3 minutes.
It's a powerful reminder of what really matters.
So it makes me wonder, is this whole tech revolution actually distracting companies from the service revolution? Are we so focused on the app that we forgot about the person at the window?
That is the question, isn't it? Popeyes proves that the human element, speed, accuracy, just a little bit of care is still the killer app.
Maybe that's the real lesson for 2026.
Yeah.
A little less tech, a lot more training.
And maybe a few more square yellow buns.
Always more SpongeBob. That's all for this deep dive. Thanks for listening.
See you next time.